Hey, it's Nolan Mathias, and this is the Thrive and Give show where we teach you how to thrive personally, thrive financially, and thrive in your business. And all we ask in return is that you pay it forward. Today, we're going to talk about investing and what you should be investing in right now and how you should be doing it. We're going to talk specifically about ETFs. We're going to talk about stocks, and we're going to talk about real estate. But before we get into it, do me that favor, hit the subscribe button and hit that like button. Ultimately, you hitting that like button determines how many people see this video. So if you like the information we're putting out and you want to know how to invest, hit that like button so the YouTube algorithm picks it up and gets this video to more people. So in times of crisis, in times of recessions, more people are made into millionaires than any other time. Some of the greatest companies in the world have been created out of the depression and out of horrible, horrible times in the economy. And this time will be no different. So what we want to talk about today is how to set yourself up to build wealth during this sort of scenario. And the reason why I'm putting this video out is quite frankly, because I'm seeing so much BS out there about investing in stocks. And, you've got Ty Lopez out there saying, hey, pick these stocks. You've got all sorts of people who have no business making stock recommendations, realtors, engineers, all this crap. And I just want to put a little bit of perspective into the market and teach you how to invest, not only during times of crisis, but also during normal times as well. And the strategies I'm going to lay out to you today are timeless. They make sense. And I'm also going to teach you how to invest right now in stocks, in bonds, and how to make good purchasing decisions on your investments. So let's talk first about ETFs. ETFs are one of the easiest things to invest in the world. Honestly, it's a set it and forget it strategy. What we do is we rebalance our ETF portfolio once per quarter. It's super easy. We set it up 70% bonds, 25% stocks, and the rest is all in like precious metals and commodities and stuff. And all we do is we pick 2 or 3 ETFs, and once a quarter, we take a look, and if the balance has got out of whack, we rebalance. So in other words, if stocks went up in value and they're now 40% of our portfolio, we pull back the stocks and we buy more bonds, and it's a super easy set it and forget it strategy. Now, what if you don't already have a portfolio? What's the strategy to start building a portfolio? The strategy to start building a portfolio is really simple. You don't want to jump in and throw all your cash in right now, especially when there's so much volatility and uncertainty in the market. What you want to do is dollar cost averaging. So that's kind of like a staggered approach to investing. And how you do that is, if you've got, let's say, $10,000 to invest, you might want to take $1,000 and invest it today. And then next month, take another $1,000 in investment. And over the next 10 months, just take that $10,000 and put it in a little bit at a time. And the reason why you want to do this is because of the volatility in the market. There's a good chance that we're going to see another big drop in the market. There's also a good chance we're going to see big spikes in the market. And if, on the first month or first day of every month, you're taking $1,000 and putting it into the market, regardless of whether the market went up or went down, over time, you're going to end up being able to build a portfolio that's a lot safer, a lot more secure, and you're going to be able to take advantage of dips if there's dips in the market. It's really one of the easiest and best approaches to building a portfolio. And not only is it easy, it's safe. So dollar cost averaging is how you want to build your ETF portfolio. By the way, if you want to look at ETFs, one of the best sources for it is Vanguard. That's just who we like. They don't sponsor any videos or anything like that. That's just the ETFs that we personally purchase. We're not saying you should do that, but it's definitely a good place to start. If you're Canadian, you can buy Vanguard funds that track the S&P 500 that are both in American dollars and hedged to American dollars. If you're American, you can just buy the S&P 500. You can buy bond markets. You can buy all sorts of different ETFs that track different indices, and it's a really simple approach. If you want more information on that, a really great source is Ray Dalio. And if you look up Ray Dalio, Tony Robbins portfolio, you should find a pretty good summary of the exact portfolio that we use. Now, let's get into the second piece, which is stocks. How do you invest in stocks right now? Well, there's 2 things you can do. One of them is really dangerous and one of them is really smart. The first one, let's talk about the dangerous one, which is speculating. So right now, there's a lot of people out there speculating and buying companies like Zoom, buying medical organizations because they think that, they might hit the lottery and find the one that comes up with the coronavirus vaccine. And by the way, I'm not saying Zoom is a bad company to invest in, but what I am saying is that purchasing stocks and bonds because you think that something is going to happen in the market that spikes their value is a really good way to lose your shirt. Because quite often what happens is, yes, a company like Zoom will probably go up in value right now, but what happens when this all settles out and people stop using Zoom the way they're using it? you might see a crash in their stock value. So you don't want to be a speculator, because speculating is what gets people into trouble. If you do want to speculate, take a small portion of your portfolio. I'm talking like maybe 10% of it, and use that as your gambling money. But don't go and use your entire portfolio and speculate and try to hit home runs, because even the best hedge fund managers in the world don't consistently hit home runs. Now let's talk about the safer strategy, which is buying great stocks at a value right now. There are companies that just do well all the time, regardless of whether the economy is good or bad. And those are the companies that you want to buy right now. They're the companies that are just strong and have great balance sheets and just are well-run, well-managed companies. And to give you examples of companies we're looking at right now that fit this mold, companies like Apple. Apple's a great company. It's going to be around a long time. Starbucks, another great company, addictive product. And by the way, coming out of this, Starbucks is going to move a pretty significant amount of its portfolio, not its portfolio, but its customer base onto its digital platforms. You know what happens with digital platforms? Like, the app that you have on your phone, you fill it with money, and then you go and you use the phone to pay for your coffee and your drink. Well, what ends up happening with that sort of product is, at the end of the year, there's going to be a whole bunch of people who didn't use up their entire amount of money that they had loaded onto their phone. And that becomes basically profit, and it's margin free or cost free profit for the Starbucks, because they've got the money in their coffers, but nobody ever actually used it. And as you see people shift from the normal platform of credit cards and cash to the digital platform, what you're going to see is Starbucks end up with a pretty significant amount of money that gets left on their digital cards and whatnot. So I think Starbucks, addictive product, coffee's not going anywhere for sure. That's definitely not going anywhere. And the switch to sort of that online payment system, you're going to see Starbucks come out of this as a company that is way stronger than they went into it. There might be a little bit of time to build back up, but over time, this is going to be something that makes Starbucks a stronger competitor in the coffee market than when it went into it as. Companies like Ford, Ford's going to come out of this really, really well. They announced today that they're creating a national supercharger network, although you can't call it a supercharger network because that's Elon Musk's thing. They're calling it the faster charger. By the way, the branding on this is awful. Look it up. It's just absolutely horrible. But, the fact that they're going to go across North America and build a supercharger network so you can take their brand new e-Mustang across the continent is pretty cool. And it's going to be a major thing for Ford. They're going to come out of this stronger. A company that we really like, and again, these aren't recommendations, this is just talking about how we invest in times like this, is Amex. We always buy it in down markets. So we started buying American Express back in 2008 or 2009. Reason why is it just is a great company that does really, really, really well coming out of hard times. So we're using that dollar cost averaging strategy right now to buy more and more Amex as we get opportunities to. So great companies, great value, and they're at a discount right now, which makes sense for them to be targets for purchase. So if you know and like great companies and you want to add them to your portfolio, now is the time to do it. Now, let's talk about the third one, which is real estate. I own a mortgage company, so obviously I love real estate as an investment. I am getting ready to purchase more real estate as an investment as we come out of this coronavirus pandemic. But that being said, I'm not going to speculate. I'm not going to buy while we're sitting in this scenario where we don't know what's going to happen. What is putting tenants into a building going to look like? What is sales going to look like? What is purchases going to look like? We don't know what supply and demand is going to look like. So we're sitting on the sidelines right now for real estate. And I think this is smart because real estate always lags when there's a recession. It's not like stocks that can react to a headline and have a $700 or a 700 point increase because Donald Trump says something this morning about vaccines, right? Real estate takes some time to play out. And what we need to know is what the market's going to look like going forward before we start getting into investing. So yes, we're putting cash reserves aside so we can start buying real estate, and we're using our investments to, hopefully grow a little bit during this time so we have more money to buy real estate, but we're going to wait and see and make sure that we're making smart and safe buying decisions before we jump into the market and speculate. Because if there's one thing you can take away from this whole conversation is that speculating is bad. Speculating is what gets good people and smart people into trouble. What we want to do with our investing, whether it's ETFs, whether it's stocks, or whether it's real estate or any other investing for that matter, is we want to use strategies that work well, that are timeless, and work regardless of market. So what that means is buying value, doing it small bits at a time, and making sure that we don't throw all of our cash into one big bet, but have a balanced portfolio that is made up of multiple ETFs, multiple stocks, and multiple asset classes like real estate, so that over time our portfolio grows and we become winners and we become wealth builders and we come out of this better than we went into it. So again, if you thought that was great information, do me that favor, hit the subscribe button, hit the like button, because again, you get to decide whether more people see this, and it would be a huge favor to me if you help me get this message out. Thanks so much.